Some of these are health policies you signed up for years ago. Some were sold alongside a fear you already had covered, and one of them is buried inside loan paperwork where most people never even notice it. 5 separate premiums or add-on policies, and on at least one of them, the money is coming out of your account right now for protection you already have. Grab a pen. I am going to name all 5, and I want you to mark every single one that applies to you. Subscribe to this channel because every year the rules change, the income limits shift, the plan benefits get rewritten, and the private policies keep drafting from your account until somebody stops them. The people subscribed here find out in time. Subscribe now and let's get into it. Before we go any further, I need to say something, because people hear a list like this and immediately sort themselves into one of 2 camps. The first group is the comfortable retiree, some savings, maybe a paid-off home, a decent Medicare Advantage plan, and you figure this list is for people in tighter financial shape than you are. The second group is on a fixed income, counting every dollar, and you have learned the hard way that the good programs are always for somebody else. Both of those assumptions are wrong about at least one item on this list, and on every single one I will tell you exactly which group it helps most and how. Some of these hit the fixed income household harder, some of these catch the comfortable retiree completely off guard, and every one of them has an action step you can take this week. Stay to the end because the last one is the premium people do not even realize got added to the loan, and it can still come off. Now, let's start with the policy that gets sold on the oldest fear in Medicare. Number 1, the hospital indemnity policy. Here is the misconception. People believe that Medicare leaves the hospital uncovered, that if you end up admitted for a week, you are going to get buried in charges Medicare does not touch. So somebody sells them a hospital cash policy, a fixed indemnity plan that pays a flat dollar amount per day or per stay, and every month a premium goes out. Here is how it actually works. Medicare Part A already covers inpatient hospital care. Yes, there are out-of-pocket costs. In 2026, the Part A inpatient hospital deductible is $1,736 per benefit period. Days 61 through 90 carry coinsurance of $434 per day. Lifetime reserve days cost $868 per day. Those are real numbers, and they are not small. But here's what most people miss. There is a set of programs called Medicare Savings Programs, run through your state Medicaid agency, that can pay part or all of your Medicare costs for you. The biggest one is QMB, Qualified Medicare Beneficiary. If you qualify, QMB pays your Part B premium, your Part A premium if you have one, and your deductibles and coinsurance. That means the very cost sharing the hospital cash policy was sold to cover could already be handled. In 2026, the QMB income limit for an individual is $1,350 per month, with resources up to $9,950. For a married couple, it is $1,824 per month and $14,910 in resources. And some states use even more generous limits than those. There is also SLMB, Specified Low-Income Medicare Beneficiary, for individuals up to $1,616 per month, and QI, which covers individuals up to $1,816 per month. Same resource limits. QI is annual and first come, first served, which means if you wait, the funding may already be spoken for. Now, who does this help most? This is the fixed income item. If your monthly income falls under those lines, or if your state uses higher thresholds, you may qualify and not know it. A study published in JAMA found that only 56.7% of people eligible for Medicare savings programs were actually enrolled between 2018 and 2020. That means roughly 2 out of every 5 people who qualified were still paying the full bill. Nobody called them. Nobody enrolled them. The premium kept coming out every single month. Here is the dollar math on the Part B premium alone. In 2026, the standard Part B premium is $202.90 per month. That is $2,434.80 per year. Over 10 years, that is $24,348. And that is before we even talk about the private hospital cash policy you were sold on top of it. Here is what to do. Call your state Medicaid agency or call 1-800-MEDICARE or contact your local SHIP office. That is your state health insurance assistance program. Use the exact words, "I have Medicare and I want to be screened for a Medicare savings program. Please tell me whether I qualify for QMB, SLMB, or QI, and what documents you need from me." 1 phone call, 2 questions. And if you qualify for QI, do not wait. because it is first come, first served every year. That is number one. The next one is the same sales logic pointed at cancer. Number two, the cancer-only policy. Here is the misconception. Someone told you, or someone told your parent, that if you get cancer, Medicare will not really cover it. So you bought a standalone cancer policy, sometimes called a specified disease policy, that pays a lump sum or a daily benefit if you are diagnosed. And that premium has been coming out ever since. Here is the truth. Medicare already covers medically necessary cancer treatment. That includes surgery, chemotherapy, radiation, hospital stays, doctor visits, and prescription drugs used in treatment. Radiation therapy is covered under Part A if you are an inpatient, and under Part B if you are treated in an outpatient or freestanding clinic. Oral chemotherapy, anti-nausea drugs, and pain medications used in cancer care can be covered under Part D. And if the time comes for hospice, Medicare covers that too. $0 for hospice care from a Medicare-approved provider, up to a $5 copayment for each outpatient prescription for pain and symptom management, and 5% of the Medicare-approved amount for inpatient respite care. The cancer-only policy you are paying for is classified by CMS as an accepted benefit. That is a technical term that means it is not comprehensive health coverage. It is a cash supplement. It was never designed to replace what Medicare does, and nobody is required to tell you that when they sell it. Who does this help most? Both groups. Cancer-only policies get sold on fear, and fear does not check your bank balance. Comfortable retirees buy them. Fixed-income retirees buy them. If you bought one believing Medicare would not cover medically necessary treatment, the premise of the purchase was wrong. Now, I want to be fair. A cancer cash policy can still serve a purpose for some people as household income replacement during treatment. That is a legitimate use. But if you bought it thinking it was filling a hole in your medical coverage, it is not. Medicare was already there. The dollar math here is yours to run. Take the premium on your bill, multiply it by 12, then multiply that by 5. That is the number you have paid for a cash supplement sitting on top of coverage Medicare was already providing. Here is the action step. Call 1-800-MEDICARE or visit your local SHIP office. Before you renew or keep any cancer-only policy, use these words. Before I renew or keep this cancer policy, I want to confirm what Medicare already covers for chemotherapy, radiation, surgery, and hospice. If the real problem is that your Medicare Advantage or Part D plan has gaps, the answer is to fix the plan during the open enrollment window, October 15th through December 7th, not to keep paying a separate cash policy. That is number two. Those first two were fear of illness policies. The next one is different. It is the quiet little monthly charge that many people with decent plans are still paying for no reason. And this is where I need you to pay close attention, because everything I have covered so far may have sounded like a list for people in the tightest financial shape. This next one is where that assumption breaks. Number three, the standalone dental discount plan or dental rider. Here is the misconception. You heard, correctly, that original Medicare does not cover most dental care. No routine cleanings, no fillings, no extractions, no dentures in most cases. So you signed up for a separate dental discount membership or a standalone dental rider, and you have been paying that bill every month or every year since. Here is what changed. If you are on a Medicare Advantage plan, there is a very strong chance your plan already includes dental benefits. In 2026, 98% or more of individual Medicare Advantage plans offer dental, vision, and hearing benefits. 98%. And if you are a full benefit dual eligible, meaning you have both Medicare and full Medicaid, your state Medicaid program may also cover dental. About 71% of dual eligible beneficiaries are full benefit duals who can access additional state benefits, including dental care. The remaining 29% are partial benefit duals who may not have dental coverage through Medicaid. Who does this help most? Both groups, but here is the surprise. This is the one that catches the comfortable retiree. You have a solid Medicare Advantage plan, you are not struggling, and you are still writing a check every month for a dental membership that duplicates what your plan already provides. Your Medicare Advantage plan does not cancel your outside dental card for you. That is not their job. The duplicate bill just keeps arriving. Here is a woman I heard from in Arizona. Elaine, 69, a retired school secretary living outside Phoenix. She had a Medicare Advantage plan that already included routine dental, but she was also paying for a separate dental discount membership she assumed she still needed. She pulled her plan's evidence of coverage, ran a comparison during the annual Medicare window, and confirmed through SHIP that her plan already covered the routine dental she was buying twice. The extra membership was pure overlap. per month, per year, gone. Here's the action step. Pull your Medicare Advantage evidence of coverage or call your plan's member services number. If you are on Medicaid, call your state Medicaid office. Use these words. Please tell me whether my current plan includes preventive dental, what the annual maximum is, and whether I am paying for a separate dental card I do not need. If you want to switch plans for better dental coverage, the window is October 15th through December 7th. You can compare plans at medicare.gov/plan-compare. That is number 3. And now we move from duplicate treatment coverage to something narrower, because this next policy usually does not even pay on sickness. Number 4. The accidental death-only policy. Here's the misconception. Any death coverage is better than none. You signed up for it years ago, or it came attached as a rider to another policy, and you figured having something in place was the responsible thing to do. That instinct made sense once. Here is why it may not anymore. An accidental death policy pays only if death occurs by accident. Death due to sickness is excluded. Not reduced, excluded. That means if the cause is heart disease, cancer, stroke, pneumonia, any illness at all, the policy pays nothing. And for adults 65 and older, illness dominates. Heart disease and cancer are the leading causes of death in that age group, well above unintentional injury. The CDC reported 197,449 total unintentional injury deaths across all ages in the United States in 2024, and that was the third leading cause overall. But for the 65 and older population specifically, the odds of a claim-triggering accident are far lower than the odds of a sickness the policy will never cover. There is another detail buried in some of these contracts. Certain accidental death benefits reduce or terminate at a specified age, such as 65. That means you may be paying for a policy right now that has already reduced your benefit, or is about to. The only way to know is to read the contract. Who does this help most? This is the comfortable retiree with old coverage habits. The mortgage is paid off. The children are grown. The household no longer depends on a payout to survive a loss. And yet the accidental death rider keeps drafting every month, because nobody ever sat down and asked, does this still match my life? It is not a Medicare duplication. It is a narrow, aging-out, low-fit policy that many retirees are still carrying out of habit. The dollar math here depends on your policy. Take the premium from your statement, multiply it by 12 for the annual cost, then multiply by 5. That is what you have paid for coverage that only triggers on accident, not sickness, in the period of life when sickness is far more likely. Here is the action step. Call your insurer's customer service line and use these words. I want the exact exclusions on this accidental death policy, the age it reduces or ends if it does, and the written steps to cancel it. Get the answer in writing. If you need help filing a complaint, the NAIC maintains a directory of every state insurance department at content.naic.org. That is number 4. At least that one arrives as an insurance bill you can see. The last one often hides inside the loan itself. This is the one I told you to stay for. Number 5. Credit life insurance on a loan. Here's the misconception. If it was on the paperwork, it must have been required. A lot of people believe credit life insurance was a condition of the loan, that they had to take it or the lender would not approve the financing. That is not true. A lender cannot require you to purchase credit life or disability insurance as a condition for obtaining a loan. That is a consumer protection rule. And yet credit life gets added to auto loans, personal loans, and other contracts every single day, sometimes without the borrower fully understanding it was optional. Here is how credit life insurance works. It is generally a form of decreasing term insurance. That means the payout shrinks as your loan balance shrinks. On day 1, it covers the full balance. By year 3 or 4, the balance is lower, but the add-on is still on the contract. The amount protected keeps getting smaller while the charge stays. And here is the cost problem. Consumer guidance from the CFPB, the Consumer Financial Protection Bureau, says there may be cheaper ways to get similar protection and that ordinary life insurance may cost less than credit life insurance. The New York Department of Financial Services echoes the same point. Credit insurance may cost more than a traditional life or disability policy. You may be paying a premium price for coverage that is shrinking and that you never had to buy in the first place. Who does this help most? Fixed income households first, because when every payment matters, an unnecessary add-on hits harder. But this catches both groups, because comfortable retirees finance vehicles and sign loan paperwork too, and the add-on does not announce itself. Here is someone I heard from. Harold, 76, a retired machinist, living outside Fort Wayne, Indiana. Credit insurance was added when he financed a vehicle. He did not realize it was optional, and he only noticed it when he refinanced the loan. He called the lender and the insurance provider, canceled the add-on, and asked for the refund owed after the refinance. The CFPB says you have the right to cancel credit insurance at any time, and that you may be entitled to a refund if you sell, refinance, or prepay the loan. Harold got his. The dollar math is in your loan paperwork. Find the monthly charge or the single premium that was financed into the balance. Multiply the monthly impact by 12 for the annual cost. Then multiply by the remaining months on the loan. That is the number sitting inside the contract. Here is the action step. Call your lender and your insurance provider. Use the exact words. Was any credit insurance, debt cancellation, or debt suspension product added to this loan? Is it optional? How do I cancel it? And what refund am I owed if I refinance, sell, or prepay? You can also file a complaint through the CFPB or contact your state insurance department through the NAIC directory. Do not wait for the loan to end. The refund window is tied to the moment you refinance, sell, or prepay, and missing that moment leaves money on the table. That is number 5. So, here is the full picture. 1. The hospital indemnity policy sitting on top of Medicare hospital coverage, when a Medicare savings program may already pay the cost sharing it was sold to cover. 1 screening call to your state Medicaid agency. 2. The cancer-only policy sold to people who do not realize Medicare already covers medically necessary cancer treatment, chemotherapy, radiation, surgery, and hospice. 1 confirmation call to 1-800-MEDICARE. 3. The dental discount card or rider that overlaps dental you already have through Medicare Advantage or full benefit Medicaid. 1 look at your evidence of coverage. 4. The accidental death only policy that pays on accident, not sickness, in the period of life when sickness is the far greater risk. 1 call to your insurer for the exclusions in writing. 5. The credit life add-on attached to a shrinking loan balance that you were never required to buy. 1 call to your lender and 1 question about a refund. 5 premiums, 5 phone calls, and nobody was going to make them for you. The state does not screen you for QMB automatically. Medicare does not call and tell you a cancer cash policy is not the same as treatment coverage. Your Medicare Advantage plan does not cancel your outside dental card for you. Your insurer does not call and say this accident-only policy may no longer fit your life. Your lender does not volunteer that the credit insurance was optional. Being legally entitled to help and actually receiving it are 2 different things. The gap between them is information, and that is exactly why this channel exists. Now I want you to think of 1 person, a parent, a widowed neighbor, or the friend from church who signs every renewal notice because it looks official, not because they are reckless, because duplicate premiums are designed to look harmless 1 at a time, and nobody is paid to look across the whole stack and say stop. Send them this video. If even 1 of these 5 comes off their bill, you just saved them real money. Subscribe. Share this with someone you care about who is over 65 and still paying every bill that arrives, and I'll see you in the next one.